Good morning. It's a real pleasure to be here. Thank you so much. Just so you all know, I am talking on the phone. I am, like so many folks in Oregon, my internet is down. So if the screen locks up a little bit or technology gets a little wonky, that's what's going on. We're going to do our best to try to keep this flowing along. Corey's going to be my Zoom meister doing the slides. So, as Corey said, please feel free to throw questions in the chat, and we'll try to make this as interactive as possible. So let's get started. Corey, can we have the next slide, please? So we're here to talk about cash and cash flow in business. Cash is king, especially in tough times. Cash is the lifeblood of business. It's entirely possible for you to be making a profit and run out of cash and even go into bankruptcy because your cash flow is out of whack. So working capital, just a few definitions. Working capital is the money to keep your business running. Cash is what you have on hand. Profit is what's left after your revenue comes in, all your expenses are paid, and then you get to see what's left for you. We talk about cash flow because, like water, it's the flow of money through your business that makes profit and business possible. The cash flow cycle, money comes in, gives you resources to buy stuff, to pay people, so you can then bring in more people, buy more stuff, sell more stuff, and kind of continue the cycle again. Next slide, please. So how to do about cash planning? One of the very most important things is generate timely financial statements. You really have to know your numbers. As a business person, you will live and die by your numbers, and it's really something that you need to stay on top of. So in business, we have three key financial statements. There's the profit and loss, P&L. There's the cash flow statement, which is, in essence, the story of your checking account. And then there's the balance sheet, which is what you owe, what you own. And it's kind of, your balance sheet is always done at a specific moment in time. And it kind of is the reflection of every business decision that's been made to the business at that point. But as a small business person, you really have to be facile with the numbers. You have to know what they are and how best to analyze them to do what you need to do to be able to run your business properly. Next slide, please. Okay. So poll number one, little quick poll. What financial information do you monitor regularly? There are multiple choices, so you can check whatever works for you. And if there's something that you monitor that's not on this, feel free to drop it in the chat. And we'll just take a minute, make your answers, and we'll see what people look at. And you'll all be able to see the results when this is done. So Corey, whenever everybody's voted, then you can close the poll and display the results.
Okay, last call.
Okay.
Gonna close.
Okay.
All right, there we go.
What do we got? We don't have a lot of people, so checking account, great. P&L, good. Balance sheet, not so much. Cash flow statement, not so much. Sales, yes. Good. Well, at least everybody's looking at something. That's wonderful. That's really good. All right. Well, let's move on. Next slide, please. So, just as a kind of a little refresher, what's on the P&L? Same thing as the income statement. It's your sales, your cost of goods, and then the gross profit, which is sales less the cost of goods. And then your expenses, what you net out before you're paying your taxes. You have to pay your taxes, and then the profit is what's left for you after all of that, which, some of which you are paying yourself, some of which is being reinvested, but that's the money that you have available to choose what direction your business goes. Next slide, please. So, a couple of key ratios, things that you can be aware of, and ways to start working with the income statement so you get a sense of how your business is running. Your percentage of cost of goods sold is very, very important depending on the type of business you're in. Because there are metrics for every industry as to what cost as a percentage of your percentage COGS should be. Your gross profit margin, just very, very roughly, what's your margin on your sales, and then the very critical break-even revenue. So that's how much money do you need to bring in every month to be able to cover your expenses, to be able to cover your nut, to be able to cover the rent and your utilities and your bookkeeper and all the sort of expense side. That's without cost of goods sold. That's just solely expenses. Next slide, please. So a couple of other ratios. What's your expense ratio for your sales? And again, that's a measure of kind of efficiency, of how much what your overhead is costing you relative to everything that is bringing in. Your profit margin as sales, and then also your break-even revenue. So how much revenue do you need to have to be able to break even every month? Next slide, please. So what's the purpose of these numbers and these ratios? This gives you some guidelines to look for trends. What's going up? What's going down? What's out of whack? You want to look for things that are creeping up, creeping down. It could be sign of inefficiency, and it could be that work. Especially in COVID, everybody's having to change their processes. So is your labor costs going up, or your cost of goods going up? The important thing is that for every industry, there are operating ratios, so you can kind of see how you fall into line and get a sense of whether you are inefficient, whether you are kind of in line. That gives you a sense of are there areas of cost control that you need to exercise? Are you doing particularly well? And there are lots of sources for industry average. You can go on Google. You can call up the local librarian. They can help you out. We at the SBDC have a tool called BizMiner, which we'll look at. It's a research tool that will look at the businesses, comparable businesses, both on a national level and on a local level, to see what kind of ratios and what kind of what the P&Ls and the balance sheets look like in aggregate for an industry. And then also, if you're a member of a trade association, very often the trade association has that sort of information. So, if you're in a restaurant business and you're in a quick food, you need to know that, industry average is about 25% for cost of goods sold. If you're kind of white tablecloth restaurants, closer to 30 or 35%. If you're running more than that, your cost of goods is 40%, then it gives you a basis to ask questions. And that's really what the numbers are there for. It's for you to look at it and try to dig deep and to find out what's the underlying operational and cost factors that's pushing you in one direction or another. Next slide, please. So let's talk a little bit about the expense management. Cutting expenses is one of the fastest ways to help manage cash. So you need to forecast the timing of expenses. In the cycle of running your business that taxes are due on certain dates, your rent is due every month. So how does that jive with the revenue that's coming into your business? But you do have a crystal ball in that regard, and you can look forward. That there's certain cycles and certain periodicities and certain expenses that come due at different times. Your insurance is due twice a year. So And if necessary, you could try to adjust the timing of some of those if you can. Taxes less so, but look to cut your overhead cost. You know, especially now in COVID, negotiating with landlords has been, many businesses are doing that. Can you get a break? Can you extend your lease and get some kind of forbearance? If utilities are not necessarily a given, with a little bit of investment in energy or water conservation, you might be able to cut your overhead, relamp and put in energy efficient bulbs. Or if you're in a business that uses a lot of water, the water conservation measures you can undertake. And negotiate with your suppliers, negotiate with everybody who you are buying stuff from and paying. You know, business is all about flexibility and negotiation. And you know, don't necessarily take price as a given. Look at your subscriptions and any of your recurring expenses or the things that you can cut there. Sometimes they just kind of show up on your credit card or bill. Or do you really need those at the moment when cash is tight? But be careful not to cut the drivers of your business. And that might mean your marketing expense, for example. It might be, things that are really helping to drive business to your door. You know, your extra signage because it's COVID and you're trying to let people know you're open. And when you do add expenses, you know, be very careful about that. When your capacity is limited, when you just need one more person to be able to operate efficiency or another piece of equipment, or if there are things that are going to absolutely drive revenue, you know that that expense is going to help you increase the amount of money coming in. So next slide, please. So if you want to drive like this is what it's all about. It's all about cash flow. And it's even nicer if you can drive a Mercedes with it. Next slide, please. So let's talk about cash flow, the cash flow statement. On a basic level, it's cash in, cash out. So, you know, from the P&L, we have the cash in. We had $13,000, that business that we were looking at before, had $13,000 in cash sales. AR, so they had some accounts receivable. They sold some money on terms. And so some accounts receivable that pays, that was $2,000. They don't have any investments, so they weren't getting any money there. They weren't borrowing any money, not this particular month. And there weren't any investments or grants coming in, new investment from partners or from other places. And there was no PPP or idle grant from the SBA coming in this particular month. So total cash in for this particular month for this business was $15,000. Next slide, please. So cash out. Well, we know that they had the cost of goods sold was $5,000 and they had operating expenses as well. But, you know, in this particular month, they also bought some additional inventory. Spent $2,500 buying new parts and pieces. And this business has a loan, so they were paying back some principal on the loan. Just so you know, principal payments go on the cash flow statement and interest expenses go on the P&L. There weren't any capital purchases, weren't buying any equipment, and the owner, you know, she has to eat and pay her bills, so she took a $3,000 draw. So total cash out that month was $18,500. Next slide, please. So we look at the cash flow statement. Bank account had an opening balance of $14,000, got some cash in, got some cash out. And what do you know? The ending balance is like they're down. But the P&L showed they had a profit. So here's how you can see how, you know, if you're only tracking your P&L and you're not tracking what's happening on cash, then you can start digging yourself into a hole. Next slide, please. So how do we manage cash? The first thing you want to do is manage your cash coming in, especially in times when of COVID. So if can you do gift cards? Can you do any type of prepaid sales? That's a way of getting money in the door. If you're in a business that is producing things, or you're a caterer or something like that, getting deposits for large orders. So you have cash to work with. Encourage people to pay by cash, by check, by debit card, and that way you avoid the credit card fees. And if you're a business that has inventory, get rid of old inventory. If you've got stuff that's sitting around that's not moving, discount it and get rid of it. If you think times are really tight and you're in survival mode, are there business assets that you can sell, things that you don't need, maybe they're depreciated. If you're in a space, and you're not using it all, you're in an office and everybody's working from home, is there someone you could sublet space to? So, some of these are kind of survival moves, but things that you may need to do. Next slide, please.
Hey, Bruce, before we go on, we have a question
Yeah.
in the chat.
Yeah.
Question is, how and where does payroll show up on the cash flow formula? Is the owner's draw the same as payroll?
If you are a sole proprietor, well, payroll for employees shows up in expenses. So that shows up on the P&L as an expense. If you are a sole proprietor or an LLC, then you are taking a draw from the business, and that becomes yours, the owner payroll. It sort of depends on the structure of your company. If you're a corporation, you may choose to hire yourself, and you are then a W-2 employee, and you're getting a W-2 at the end of the year, and so you are then on the payroll on the expense side. But for LLCs and for one or two person companies, then the owner's draw is your payroll. Does that answer the question? Is there a follow-up to that, or is that kind of cover it? Okay, great.
Yes, you're good.
Yeah, okay, great. So the other very, very important, and this important part of managing cash is managing accounts receivable. If you are selling services or items on terms, this is the money that you are lending to other people. So what are the terms of your business? Are you giving them net 30? Are you giving them net 60? Are you giving them 15 days, or is it cash on delivery? If you have accounts receivable, and just so you know, accounts receivable actually shows up on the balance sheet. It doesn't show up on the cash flow statement. So we've kind of jumped over into the third financial statement, but it's a very, very important number, and it's one that you should get generated regularly from your bookkeeper or yourself. If you've got accounts receivable out there, can you give them a discount for paying sooner? If you have to draw on a line of credit that you're paying interest on, it might be cheaper to give somebody a 2 or 3% discount if they pay within 10 days or 15 days or pay within the week than you having to borrow money to operate your business because you're essentially loaning it to somebody else. Go talk to your bank, figure out how to enable direct deposit if you've got regular customers who are working with your business. Can they do direct deposit? Make sending invoices your highest priority. You want to bill them regularly. Put a due date on there. If you're just sending out mail, send self-addressed stamped envelopes. Make it easy for people to pay. If you've got a grace period, reduce that grace period for late payment. But really, are you on top of your collections? You don't want to be too aggressive, or you turn off your customers, but you want to collect as fast as you reasonably can. And in fact, for every industry, if you look at some of those industry ratios, you can often find out what's sort of standard for your industry in terms of accounts receivable terms. And you certainly don't want to be worse than the industry. You want to try and do a little better. So let's look at some numbers and some ratios. So how do we figure out, next slide. So accounts receivable, how fast are you turning over your accounts receivable? How fast are they coming in? And so, you know, your ratio is about, so this is also per period. So we're looking at over the course of a year, if you've got accounts receivable, how fast are they coming in? Well, they're coming in 10 times during the year. What's really interesting is to look at that in terms of days. You take that accounts receivable ratio divided by 365 days in a year, and you see that you're collecting your receivables every 36, you know, every 36 days. Well, if you're giving people 30-day terms, then you're slow in your collections. It's a really good way to tell how you're doing. Are you collecting money fast enough? And do you need to do something to improve your receivables? So really staying on top of that is very important in terms of cash flow management. Next slide, please. So, so let's see, poll number 2. What metrics do you know or are you tracking? So let's see what. Are answers coming in?
Yes, slowly.
Great. Slowly. Okay.
Oh, they're coming. Here, we'll give it another 20 seconds.
Okay.
I think we'll be there.
All right. What do they say in Las Vegas? Place your bets. This case,
Okay.
great. So what do we got? Profit margin, great. Percentage COGS, wonderful. Break even, not so much. So that's a really important number. So operating expenses, percentage of sales. So yeah, so I hope that you'll see by the time we're done with this presentation some of the value of actually tracking some of these percentages for your business. And obviously, there may be business where some of these don't matter. If you're in a service business, your percent COGS is irrelevant. But there's still profit margin, other things are still extremely important. So next slide, please. So similarly with accounts payable, you know, essentially you want to pay as slow as possible and still, you know, preserve your relationships with your suppliers. You want to bring money in fast and you want to send it out slow. So think about how your processes for this. Pay your suppliers as they come in according to the terms. Just don't have one day a month that you make all your payments, because you could be, you know, paying somebody back, you know, the day after the invoice comes in, when they're giving you 30 days. So you are giving up the opportunity to use their money for 29 days. So so sort of as things roll in, think about, you know, when you're going to pay them. Negotiate terms with your suppliers, especially in tough times. If you've been good to your, and in good times, it's good to be good to your suppliers. In tough times, maybe they can give you a little more time. That's basically a low-cost loan. So instead of, you know, net 30, maybe they can give you net 45 or something, or a little bit longer. So you can also look, just like you can look at the turnover and the speed at which you're bringing money in, you could also look at the speed at which you're paying money out. So in this case, rather than using a year, we're using a month as the time period. And so, you know, we can generate the ratio, which is how fast we're turning it over. In this case, the period of time is a month. So we're actually paying our accounts payable twice in the course of a month. And if you look at that, you divide that by the 30 days in the month, then this business is paying in 25 days. So they may be paying too quickly. So that's, again, another ratio that you can use to decide how you're doing and whether there's a change in your operation that might be, in your process that might be worth doing, you know, to take maximum advantage of the terms that your suppliers are giving you. Next slide, please. So cash flow management is really about projections and looking into the future. And, you know, first of all, let's, you know, all acknowledge that the future, everybody's view of the future has been completely shredded over the past year. Anything we thought we knew about the cycles in business and what was going on has just been, you know, just run over by a Mack truck. That said, there are certain things about the nature, you know, you do have past history about your business, and there are things about the nature of your business that you do know that you can use to help plan for. You do know the cycles. And obviously some of those cycles have been disrupted by COVID, but what are the new cycles? But, you know, retail always, Q4 is always when retailers, you know, make their money. It's always that holiday season. They know that Q1 is typically slower. And so use what you know about the cycles of your business. And, you know, one of the things that COVID has done is that it has shown kind of how bad things can get. And so based on that, you know, what is it, and come up with a scenario. It's like, what's the best case? How fast can I reopen? What's the worst case? What happens if I get closed down again? What happens? So you now have some glimpse of what the future can look like, and how does that translate into revenue, into money, and into expenses? And looking at the timing of your revenue and expenses. You can plan for the lean times, but also plan for expansion. When are you going to be able to reinvest again? When are you going to be able to buy new equipment, or maybe bring on a new employee, or move your facility? I mean, you know, there's going to be a lot of cheap real estate out there now. So it's a time for you to think about, in a year, making a move. Maybe you can renegotiate a cheaper lease and move. And then planning for capital needs and for working capital. The working capital meaning the money that you need to flow through your business, and capital needs meaning equipment and long-lived assets that you might need to buy. Next slide, please. So this is an example of what this looks like, and this is kind of an eye chart, so I don't expect you to digest all the numbers. But the point is, this is a tool that we at the SBDC have. It's an Excel spreadsheet, and it's something that you can use. It's available to you. Get in contact with us, and we can show you that. But you see that month by month, this business has some cycles, and so cash comes in month by month. And then collections, line 14, accounts receivable. And you see that there's huge swings in accounts receivable. And in this case, the person's planning when their accounts receivable are going to come through based on their sales. And then you have total cash available. And you can see, if you look at the bottom line, 25, that the cash position changes dramatically over the course of the the 7 months of this sheet. Also notice that on line 20, capital purchase. So here's somebody who actually invested in some new piece of equipment. And so again, you can use this to sort of plan out when you expect money to come in, when you have to pay certain things, and when it might be right to reinvest. Next slide, please. So if you're in a business that has inventory, managing inventory is extremely important, especially in these days. So as we saw, you can measure the turnover for the money that you've got invested in your inventory. How fast are you turning that? And again, this is sort of a measure of kind of efficiency. The faster you can turn your inventory, the better, because the faster you're turning it means you're bringing more money into the business. So look at an annual basis, and inventory figures typically come from balance sheet. So you can see that this person's turning over the inventory 12 times over the course of the year. Again, you can turn that just with those other ratios. You can turn it into days. So every 30 days, they're turning it over. Is there something that they can do to turn it over faster, or is that pretty typical for the industry? If you have inventory, can you reduce the stock that you hold for safety purposes, for your margin? Unless, of course, your supply chain is so disrupted because of COVID that you got to buy it when you can get it. because these are not normal times. So, but typically, everybody who's holding inventory has some sort of safety reserve. If you have a pretty solid supply chain, can you reduce your lot sizes? Yeah, you know, often you get a better break for buying a larger lot size, but can you go a little less just to reduce the amount of cash out? And then reduce the inventory and finished goods on hand. Can you let that get drawn down farther? You know, and every business has their own cycles and their own. But really, you want to match inventories to sales and reduce stock as much as you can. Next slide, please. And then finally, you need to look at your capital structure. How is your business financed? What are the primary sources? Where are you getting money to run your business? You've got your cash, you've got accounts receivable. Do you have a line of credit at the bank? If you don't, you're right, and you think you can get one, it can be a very, very good thing to have to tide you over in between the ups and downs in the cash flow cycle. Are there grants available? You know, we're in a really interesting situation now with all the stimulus that the federal government has made available, but never before have there been as much grant money to as broad a range of businesses as there have been over the past year. That doesn't mean it's been easy for businesses, because I work with businesses every day that are you know, fighting to try to get, you know, the PPP loans and things like that. But for many, many, many businesses that have sustained losses, we're fortunate enough to have grants available. But really, it's also a matter of matching the sources and the types of capital. You want to buy long-term assets with long-term loans and short-term assets with short-term loans. You do not want to buy an expensive piece of equipment on a credit card. You don't want to buy inventory that will take you 6 months to use on a credit card, because it's going to take you 6 months to use. You're going to be paying high interest rates for that. So you really have to balance out your long-term debt needs and your short-term debt needs. And this is the opportunity to talk to your banker, or if you have other sources of credit available. You know, are you bringing an investment or a partner? Are you really constrained? Do you need more capital to be able to grow your business, sustain your business? So looking at the capital structure, a lot of businesses tend to use short-term money for long-term assets, and you're overpaying to do that. And because if you have a long-term piece of equipment, it's going to be generating value for a very long period of time. And so then you can afford to have a loan that lasts for a while. You know, you don't want to buy, you know, like a car, a vehicle. Is, you know, a 3-year loan is great. You don't want to buy it on a credit card, if you even could, and you know, pay high interest rates, and it takes the long term to pay that off. So next slide, please. So to kind of summarize, what's kind of the secret of cash flow planning? You've got to know your numbers. You've got to know what numbers are important to your particular business and your particular industry. And you as a business owner have to work with them. Don't just rely on your bookkeepers or your accountants. And if there's stuff that you don't understand, talk to them and get them to be your partner and your advisor and your ally to be able to digest these. But what are the key things that you need to know? Is it sales per day? Is it cost of goods? Whatever it may be. And then start projecting forward. Dust off your crystal ball and make the best guess as to, or several guesses as to what could happen in the future. Boost your income coming in. You know, money coming in faster is always better. Money coming in quickly is really what you're aiming for. Manage your receivables. So that is a big source. If you're not managing your receivables, you are giving no interest loans to the people you're doing business with, and so you have to think about it in that regard. That may be the structure of your industry, but you certainly don't want to be doing that. Be more generous than people in the rest of your industry. Or you can, try to make some new rules. You want to manage your cash going out. Slower is better. You don't want to be stiffing people, and you want to be good to your suppliers, but you don't want to pay any faster than you have to. Manage your inventory, turn it as fast as you can. Don't carry large extra parts and pieces that you don't need to have on hand. And then look at the capital structure of your company and really think about how you are using the capital that's available to you, and are you paying the right amount of money for the right kinds of assets? So that's pretty much it. Next slide, please. So we at the Small Business Development Center are here to help. We have business advisors who work with all aspects of small business, from marketing to, I work with helping people with finance and helping people get access to capital. We have a large number of, we have classes for every stage of business development, from people who are just starting out to people who've been in business for 15, 20 years. So we really try to hit people where they, make the resources available depending on what people's needs are. And with all of our classes, there comes no cost advising. The way you start is you go to the SBDC site, go to Portland, and down there at the bottom of the screen, you'll see it says register, and you hit the button and register, and that'll get you into our system, and then we can help to figure out what your needs are and how we can help you. Also, especially during the pandemic, we have been providing a lot of assistance to people who are working with economic injury disaster loans, working with the PPP loans, and figure out applications for that, and also thinking about how best to use that. So that's what we do. And please feel free to reach out to us. Questions?
So there is one in the chat. I'm not sure if you can read that or not. I'll read it for anyone who may not be able to see it. It says, this is from Seth. Do you have any suggestions for a safe ratio or percentage of business operating expenses coming from LOC or other short-term loan, or other short-term low-interest debt versus retained earnings cash flow, or a minimum number of weeks, months operating expenses to keep on hand for a safe, conservatively financed small business?
Off the top of my head, no. Depending on the industry, there may be there's data available for your industry, probably. 6 months operating expenses in these. This is just me off the top of my head, but keeping 6 months operating expenses on hand would, this has been such an unusual and difficult time that would not be unreasonable. So, yeah, but, I think in these times, in terms of percentage of business operating expenses coming from, it really depends on the business. So we can dig into that. There are ways to dig into that, but I don't have an answer ready answer off the top of my head.
I'll just share one quick thing. I previously worked in the tourism industry for a nonprofit, and our CEO was one that appreciated and valued savings and putting money away in a regular savings account. And as a nonprofit, there were some that were critical of that practice because it was money that felt like it should be used and spent to serve those that the nonprofit was there to serve. And then COVID hit, and this nonprofit is able to continue because they had such a high reserve in their savings account. So if you're anything like me, you're rethinking your saving practices, which for me has not been great. So,
other questions? It's been a real pleasure, working with you, and I hope this has provided some places to start. And, know that if you want to start digging into your numbers, there's lots of other ratios out there, and a lot of this information is available, readily available on Google or Finance Sites or Investopedia. But it really depends on, what type of industry you're operating in, and trying to understand where you fit in, and what's appropriate. And some of these, you just have to also, like the business owner who emailed, who chat question a moment ago. Some of it's a question of what you're just going to feel comfortable with. Nobody expected COVID. Nobody knew how bad it can get. So having reserves is certainly good.
Bruce, I have a question about, for any company that may be involved in events and may sell sponsorships or tickets. So in a time like now, where let's say you're planning a fall event and you think you can have it, but you're not really sure. And in the event that you don't have it, you have to refund ticket sales and maybe sponsorship money that you collected. Does that money that you collect now, do you treat that any differently than you would in normal circumstances?
Yeah, I wouldn't. Yes, I wouldn't spend it. I mean, that's a liability. That's a liability on your books. I mean, that's a service that you have sold that you have not delivered on, and so you have to be, just as a matter of finance, and as a matter of good, being able to stay in business in the community and have customers who will trust you. You have to treat that very, very carefully. I mean, prepaid sales and things like that are great if you can get them, but know that that's a liability, and that is something you have to deliver on. And so I'd be very, very careful with tickets sold and sponsorships for us. And that's a problem. I mean, it puts a business in a very, very tough bind. I don't want to minimize the seriousness of that, but you do have to find a way. If this goes south and this can't happen, how am I going to make whole the people who are counting on me? Because that's the most important thing.
Do you account for those numbers in the same way that you normally would, like on your P&L and your cash flow statements?
Yeah, I mean, it's cash. So I'm not an accountant, and you need to sort of talk to your accountants about that. But I mean, that is, that is cash in. It is cash in. It sits there on your, and it's just sitting there in your cash balance. So it's money. In part, it depends on what accounting method you're using, whether you're using accrual or cash accounting. And again, but I think the important part is, don't spend it if you don't think you're going to be able, however you account for it, don't spend it if you don't think that if the thing doesn't happen, you won't have a way to repay it.
Thank you. Does anyone else have any other questions that they'd like to ask? You're welcome to unmute and ask verbally if you'd like, or again, you can use the chat. And maybe while we give them another minute to consider that, I have one more question that I wanted to ask. I don't know if we have any new startups or people who are entrepreneurs who are thinking of starting a business, but how does that, when you're first beginning a business, what advice would you have in terms of helping with the cash flow? Because obviously you're probably going to have more expenses up front than you will have money coming in for a while.
Well, you know, we work with startups all the time, and one of the first exercises we have them go through is the cash flow projections, because that is that's you know, during a start, it depends on the nature of the business, but you know, if you are moving into a new facility and you're doing a build out, for example, you're going to have 2, 3, 4, 5, 6 months where you've got no money coming in and everything going out. And you have to account for that period in your business plan and in your cash flow projections, you know, and then you get to open your doors, and then you have sort of, you know, money trickling in and then hopefully flooding in. But projections are very, very important, because you need to figure out how much startup capital you need. If you are borrowing money, you need to figure out how much you're going to borrow, and you really need to pay a lot of attention to the capital structure of your of your business. You know, if you're opening a restaurant or a facility or a retail store, you know, that's really where you get into a finance strategy for a business, and how much money do you need to open and to operate, and what's the best forms of money available to do what you need to do. You know, sometimes we counsel people, if you're opening a restaurant or a facility, can you lease the equipment instead of buying it? So you're preserving your precious capital and just paying a smaller amount of money rather than plunk out $25 or $30 or $50,000 on a piece of equipment right then, and then you've depleted your operating capital. Does that answer the question? Or?
Yeah, no, that's great. Yeah, thank you. Okay, we got time for maybe one more question, if it's out there. Otherwise, I think we can go ahead and wrap this up.
I want to say thanks very much for giving us the opportunity to present. And again, SBDC is here to help you on your business journey. And we have a lot of incredible professionals who are available to help with that.
Okay, well, with that then, let's go ahead and we'll close. Thank you, everybody, for your joining us this morning. We hope this was helpful for you. And just as a matter of reference, we have 3 more of these sessions that we are doing, each on the 3rd Thursday of each month through June. So we'll be in touch and invite you to those if those topics are of use for you. So thanks again, everybody. Thank you, Bruce, for your presentation. I think that was very helpful for a lot of people, and we'll look forward to maybe doing this again with you another time.
Great. Thank you.
Okay. Thanks, everybody.